Good morning, good afternoon, good evening, wherever you are in the world. Welcome to this new session of the Financial Statement Series at the Peterson Institute for International Economics. I'm Nicolas Veron. It's my pleasure to introduce it on a Monday, unusually, but Monday morning for the US participants. Thanks for joining us. The next session will also be on a Monday in just 1 week's time. I will come back to it at the end. Today, we'll discuss Chinese companies and especially Chinese corporate listings and whether they will continue to list abroad outside of the mainland. For this, we have two incredibly expert speakers. Wu Weijing, also known as Laura Wu, is studied at Fudan University in Shanghai and master's and PhD at Oxford, where she got her PhD in economics in 2010. And since then, she has been in the faculty at Nanyang Technological University in Singapore. And I think, Laura, behind you is a beautiful picture of the campus of Nanyang University. So go Singapore. She's been an associate professor at Nanyang Technological University since 2019 in economics. She has also worked for a stint at the International Finance Corporation and the World Bank Group, and has been involved in many policy debates and with numerous academic publications. Also with us today is Wendy Liu. Wendy got her bachelor's degree at the University of Kentucky and had an MBA, Master's of Business Administration from Columbia University in New York. She worked in trading and buy-side finance investment in New York City, and from 2000 was working at Merrill Lynch. After that, at ABN AMRO, which then became Royal Bank of Scotland, and in 2012 joined Nomura in Hong Kong, then UBS, and since 2021 JP Morgan. So you have seen all the different sides of the sell side and the buy side, the financial industry from many different angles. And Wendy has been through all those years leading strategists for China and especially Chinese equities. With that, Laura, over to you.
Hey. Thank you so much, Nicholas, for having me, and for the very generous introduction. So apparently, Nicholas has raised a very interesting and important question that I decide to approach in 3 steps. The first is to try to understand why so many Chinese firms have listed overseas in the first place. And the second step is try to take a review what has happened in recent years to these firms so that the question in the title would arise. And finally, hopefully we can make some reasonable projection on what might happen to these Chinese firms in the future. Okay. Nicholas no doubt raised a $1 trillion question. China is well known to lead the world in the number and value of overseas listings. Hong Kong and US are the top 2 most popular destinations outside of China for Chinese issuers. If we look at data at the end of 2020, before the regulation storm started, there are about 1,600 Chinese firms listed in Hong Kong and the US, with 4.5 trillion market cap in Hong Kong and 1.9 trillion market cap in US. As some firms cross-listed in both markets, without any double counting, these firms have a total 5.3 trillion USD market cap. And what are these most dynamic firms? Well, these include those solely listed in Hong Kong stock market, for example, Tencent, those solely listed in the US stock market, for example, Pinduoduo, and a bunch of firms which cross-listed in Hong Kong and then in US as ADRs. These include Alibaba, Baidu, and Jingdong. So if you are interested, there is absolutely a long and impressive collective journey for Chinese firms listing in overseas markets. And I would like to refer interested readers to my recent survey paper joined with my 3 co-authors in the paper in the hyperlink. And of course, a lot has happened since 2020. And if you look at the Nasdaq Golden Dragon China Index, it has experienced a landslide during this period, and it didn't come back even until the very recent. So what has really happened? And in particular, will these Chinese firms keep listing outside of China, and in particular in the US market? So if you look at an IPO market, there are 4 major players. From the supply side, these are Chinese issuers. From the demand side, there are international investors. And on top of that, there are regulators from both Chinese and US authorities. So I'm going to take a quick look at 4 major players, what has happened to them, and what might be their decision. So let's start with the fundamental decision of the supply side. Or why do so many Chinese firms list outside of mainland? Well, on top of the general motivation of cross-listing, Chinese firms do have a set of specific reasons of overseas listing. And this can be summarized as to bypass mainland China's capital market regulation. In our recent working paper, we highlighted these 4 market regulations. The first is so-called a negative list to foreign investment, so that Chinese startups which have received foreign venture capital investment are not allowed to list in mainland China. And therefore, many of them have chosen to list outside of China using so-called variable interest of entity structure. A second reason, Chinese mainland stock market is well known to have stringent financial eligibility requirements. For example, before the recent IPO reform, firms or applicants of IPO must have made positive profits for 3 consecutive years before filing an IPO in order to list in the mainland board. And the third reason is, even for those Chinese firms that are not on the negative list and meet the financial listing requirements, there is well-known administrative IPO approval system in China. And this is opaque, this is prolonged, and with a lot of uncertainty. So for issuers who cannot wait or take the risk of uncertainty, they choose overseas IPO as an alternative. Last but not the least, China still has strict capital control, in particular capital outflow control. So for many Chinese entrepreneurs, they are not only keen on raising money, but also keen on protecting the money raised from IPO. And in this case, an overseas IPO is a legitimate way for Chinese entrepreneurs to move their wealth across the board. So with these 4 reasons, we studied what is the effect of an IPO, overseas IPO. And we found overseas listed Chinese firms are on average better than domestic listed counterparts in terms of high ROA, high growth potential, and better corporate governance. However, these firms, for them, their on average Tobin's Q is about 60% lower than if they were listed in mainland China stock market. Which means...
Sorry, Laura, for interruption. Can you just remind our audience of very briefly the definition of Tobin's Q?
Oh, Tobin's Q is defined as the market value of the stock and the debt over the book value of the total assets. So it's very similar to PB ratio if the firm is fully financed by equity. So it's a measure of valuation. Therefore, an 18% welfare loss for Chinese entrepreneurs due to this capital market distortion in China. Now, this has important implications because it suggests there is a substantial willingness to pay of Chinese entrepreneurs to bypass capital market distortion in China. Or alternatively, we can say there is a strong fundamental motivation of overseas IPO for Chinese entrepreneurs. Okay, so this is the demand supply side. Now let's look at the regulations from the US side. Okay, the first regulation is executive orders. both President Donald Trump and Joe Biden have signed executive orders, which prohibited all U.S. investors from purchasing or investing in securities of companies identified by the U.S. government as communist Chinese military companies, or having ties to China's military or surveillance industry. Okay, and today the Office of Foreign Assets Control is now in charge and updates the list, the negative list. So this is the first set of regulation. The second set of regulation is probably well known to audience of this webinar, which is the Holding Foreign Company Accountable Act. I referred to a very interesting webinar 2 years ago, also organized by Nicholas for the financial statements for the decade-long dispute on China-US audit. So let me update you what has happened after that. I would say the delisting risk was real when we look at March 2022, SEC published a list of commission identified issuers under the Holding Foreign Company Accountable Act. And since the House passed the amended Holding Foreign Company Accountable Act, these commission identified issuers by earliest would face trading prohibition as early as 2023. And that's why Chinese authority has been in constant negotiation with the US authority until they reached a protocol agreement on 26 August 2022. And then starting in September, PCAOB started an on-site audit inspection in Hong Kong. And at the end of 2022, PCAOB finally vacated its early determination. So today, according to the most updated statement from PCAOB and SEC, there are no PCAOB identified jurisdiction, and therefore there are no issuers at risk of a trading prohibition. However, PCAOB could, in the future, make a new determination, and if so, the amended act would apply to the commission identified issuers. In other words, they will face trading prohibition in 2 years. In addition, as a result of this audit dispute, additional disclosure requirements are needed for the 174 already identified issuers under this act. And recently, SEC also issued highlighted risk factors for China-based issuers in additional disclosure obligation. As you see, these factors related to government entity and a relationship with the CCP, and of course, with other concerns. Okay, how about the regulation from the mainland China side? They are also a big change. So starting from Ant Financial Group, last minute IPO calls, the China authority has started a set of crackdown in order to prevent the so-called disorderly expansion of capital. And as you see, this crackdown mainly affect digital platform firms, those firms in online education, those firms in game sector, and those firms with a lot of users under the name of anti-monopoly, investigation, and data or cyber security. Of course, the tune has changed when the Chinese government weighed control versus growth. And therefore, starting from 2024, the private companies and the technology industries have received more support than before. And these firms are indeed firms. Most of these firms are indeed firms listed in the US stock market. Okay, the second big change is the compromise Chinese authority made under the Holding Foreign Company Accountable Act. As we see, the statement from the US version and the China version are slightly different. However, the key change is China finally conceded and to change the position from China-led inspection to China sent regulators to Hong Kong to assist US audit. And this is because the delisting clock was really counting down back to summer of 2022. And On the opposite side, at the beginning of 2023, CSRC launched this number 43 file or document, which is called Trial Administrative Measures on Overseas Security Offering and Listing by Domestic Companies. Well, in short, this file reopens a pathway for companies that align with China's regulations to raise capital on foreign markets. And in particular, firms with VIE structures is first recognized and formally defined under this indirect overseas offering and listing according to these new measures. Now, finally, let's look at what are the fundamental concerns from the demand side. Well, probably the first one is still the variable interest entity. Although as a result of recent heightened regulation from both US and China, there is greater transparency between the VIE and the Chinese operating entity. However, the legal status on US investor ownership in the Chinese operating entity is still dubious. As a fact, if you look at data early this year, 166 US listed Chinese firms use a VIE, with a market cap nearly 800 billion, or more than 90% of the total market cap of US listed Chinese firms. While the concerns on VIE are fundamentally traditional concerns that limit financial globalization. That is, first, outsider investors risk expropriation by the insider controlling shareholder. And second, all investors, in fact, risk expropriation by the state. However, on top of these traditional concerns, these days, no doubt, international investors face new concerns on US-listed Chinese firms under the big background of US-China financial decoupling, especially in light of the recent outcome of US presidential election. Okay, in early years, international investors are willing to take this risk in exchange of higher return by investing in Chinese firms. However, there is a general growth slowdown and sagging consumption trends in recent years for China. Although starting from the end of September, there had been a set of stimulus package by Chinese authorities. It is still remains to be seen whether the recent stimulus bliss would be a game changer. I guess that's why investors with big risk appetite, such as Michael Barry, added a holding to Alibaba, Baidu, and Jingdong in the third quarter, but meanwhile bought puts on the same stocks to hedge. Okay, so now let's come back to my starting point. After this review, we find Chinese authorities have become conditionally supportive or more supportive on Chinese firms going overseas IPO. Although these firms do face great scrutiny and enhanced oversight from the US authorities. Now, international investors have to trade off between higher risk and probably lower return. So what will happen to the Chinese issuers? My projection is they may take various paths. The first path is delisting from the US. Now, all Chinese SOEs have voluntarily delisted from US exchange. And looking forward, foreign Chinese firms are unlikely to list in the US. These are firms with Chinese government ownership and CCP relationship, and firms on the negative list of the executive orders and from sensitive industries. And from China's point of view, firms with concerns on national security and cybersecurity are not going to get the green light up. And second path, of course, is to look for alternative. Hong Kong Stock Exchange has been and will be an important backup for large tech firms. And in particular, since April 2018, Hong Kong Stock Exchange has launched 3 new chapters in its listing rule. And more recently, implemented new rules of changing listing status from secondary listing to dual primary or primary listing. And therefore, as we have seen, many Chinese firms have make Hong Kong Stock Exchange as their home or second home. Some firms choose to delist from the US and then seek for primary listing in Hong Kong Stock Exchange. And others have a secondary listing in Hong Kong Stock Exchange, for example, Baidu, Jingdong, and NetEase. And also, other firms upgrade their secondary listing to dual primary listing in Hong Kong and US. For example, Beijing, Yum China, and Alibaba. Okay, the third path probably is homecoming or just to seek for a home IPO. As we mentioned earlier, due to the economic slowdown, China has been more welcome on foreign investment in recent years, and therefore the negative list has been getting shorter and shorter over the years. On top of that, China has also reformed its IPO market. In particular, there is a launch of the Star Board in 2019, and which with lower financial eligibility. And there is also Beijing Stock Exchange, which targets small and medium enterprises. And meanwhile, China finally reformed its so-called administrative approval IPO system into the IPO registration system. Therefore, an IPO at home market, at least in principle, becomes more likely for Chinese companies. And this is happening. Some firms choose to delist from the US or Hong Kong stock market. Remember, they face significant valuation discount. And indeed, when they choose to relist in mainland China stock market, and most of them really experienced a substantial increase in their valuation. And if you look at our Chinese mainland China IPO market, in the past 5 years, mainland China has been the world's largest IPO market. On average, every year, there are about 400 new IPO. And in particular, in year 2020, 2021. And so that by the end of 2023, there are more than 5,300 firms listed in mainland China. And there's still a relatively healthy pipeline in mainland China's IPO market. Okay, finally, the last path, I call it take the bull by the horns. Indeed, this figure shows the number of IPO and proceeds raised by Chinese firms in the US market from 2019 until October 2024. And what we found is when there was really a substantial decline in 2022 and 2023 IPO market, 2024 witnessed a substantial increase. In terms of number of IPO, that's 47, that is the highest in the past 5 years. Of course, the IPO proceeds raised is substantially lower, only 2.7 billion compared with the peak, let's say 14 billion in 2021. This means US remains a popular destination for private Chinese firms. But these Chinese firms are much smaller and they are still high-tech firms. And they still want to go public in US, despite the trade, the political, and the regulatory tensions between the two countries. And I think this is fundamentally driven by the motivations highlighted in our research paper. Okay, Nicholas, I will stop here, and I look forward to expert view from Wendy and from you. Thank you.
Thank you so much, Laura. This was very impressive. I completely failed in my time discipline enforcement duties, but that was well worth it because there was so much density of information and insight in your presentation. So thanks a lot, and Wendy, over to you.
Hi, Nicholas. Hi, Laura. I'm happy to share some of the perspectives around China equities so that in this context, we have an understanding of the cycle. And then also, before I start, I wanted to share with everyone that my first job was at JP Morgan. So after a very long detour, now I'm back at JP Morgan about 3 years ago. So 2024, when I came to Asia, it was all about growth. Investors 2004, okay? investors were looking for growth in Asia. And then we come 2007. It was SOEs producing earnings at the cyclical top and commanded a valuation based on PEG, right? And fast forward to today, we're now in the fourth year of post-peak property price and peak equity price, which was registered in Q1 of 2021. We're seeing signs of a bounce back, signs of a better risk appetite for Chinese equities during this year, but there's quite a bit of volatility. So if we just look at the earnings from 21 to end of 23, earnings coming out of MSCI China was much weaker than those from Japan and India at the same index, MSCI index level. Those two markets each were able to grow by more than 60% in US dollar terms, but MSCI China's earnings on a 12 months forward basis declined by 12%. So it was the worst performing market within APAC. 24 was slightly different. And now when we look at full year 24 and full year 25 on the earnings basis, it may look a little bit better. But then we have geopolitical risks coming up under the new, upcoming presidency. So I think this is an asset that has gone through a supercharged growth cycle, asset price appreciation, and now has had a pullback, which is very substantial. And it is coming out of that process needing consolidation and needing some fundraising for some of its enterprises, but it's somewhat different than 20 years ago as a red hot growth market. So we're looking for consolidations, we're looking for sector leaders, and we're also looking for innovators. When we compare MSCI China with topics, and what we found is that MSCI China appears to be in the late 1997 equivalent of topics in terms of valuation measured by standard deviation to the running averages. And if we look at the key frameworks around how we analyze the equities market, then it would appear that the macro growth cycle has somewhat stabilized. The property cycle has somewhat stabilized in terms of pricing. We're seeing signs of that in 3Q. And the EPS cycle has also gone for the better, but the NPL cycle is still unfolding. And the regulatory cycle in China, given anti-corruption, has made it difficult for part of the economic activities to recover. In fact, when we look at the sectors that have been impacted by anti-corruption, growth tend to take a hit, and business confidence also tend to take a hit. Okay, and so we're at this adjustment process where companies need to deliver more. Investors are becoming more demanding, and they need to show a balance of profitability vis-a-vis growth. So I think it's actually a better time for the buyers in that regard. And we have previous growth companies now becoming value companies. So we have previously value investors become more interested in some of the companies listed, particularly the internet cohort that's listed in Hong Kong. So for next year, I think people are very keen to find out what could happen with the Trump administration. So we're looking at, what could do well under the Trump trade vis-a-vis what did well previously under the Harris trade. But I think in the end, it's going to come back to earnings growth on a single stock level. And so having this rigorous process of IPO listing is generally a good thing for investors, so they understand that, you know, the listed asset has been checked out. And with that, I'm happy to give the mic back to Nicholas and see, you know, if there are any questions that I can help answer.
Thank you so much. And we have a number of very expert people in the audience, so I also encourage them to raise questions through the Q&A tool. But let me start with the process with the US PCAOB, the Public Company Accounting Oversight Board. Laura, you mentioned the agreement that was reached in 22. How do you see that working going forward? Let's assume for a moment that there is no major change, which may be a strong assumption under the US regime in terms of the priorities of the PCAOB. Is it your impression that the kind of understanding that was found with, you know, US authorities going to Hong Kong, Chinese auditors bringing their working papers to Hong Kong, US authorities looking at the working papers there, and essentially having the access they need to the information they want to see. How durable is this, and what could derail that process? Maybe let's start with that.
Sure, that's a very good question. I didn't have time to fully explain, you know, the most status quo, the recent status quo. According to their statement made by, I think, PCAOB, in May 2023, PCAOB already completed inspection of these audits, which Chinese issuers have used, which count about, I think, 45%. And then by the end of 2023, 99% of the market cap, okay, from these Chinese listed companies have already been inspected. So in this regard, as the most recent statement made, there is no concern in terms of Commission identified issues. So the inspection has done.
Did it take you by surprise? I remember in August 22, when the agreement was announced, there were many skeptics in the marketplace saying, you know, this is a concession, but made out of bad faith. It will never work in practice, and it's a recipe for further uncertainty. But it doesn't really look like that's the way it has developed so far. So what have we learned through that process, in your view, Laura?
It actually also came to a bit surprise of me, as PCAOB announced at the end of 2023, it finished the inspection for 99% of the market cap of Chinese issuers. I think part of the reason is those firms, in particular state-owned enterprises, they have chosen to voluntarily delist it from the US market. And that's why the remaining, yes, let's say, you know, right before CSRC and PCAOB signed the agreement, 4 large Chinese SOEs, they delisted. And then when the inspection started, the last 2 Chinese SOEs, China Eastern Airline and the China Southern Airline, they delisted. So I would say the remaining firms listed in the US stock market have no concerns with the access to their audit working papers. And we can also check the announcement made by PCAOB. And so far, there are some fines, but these fines are made to PwC Hong Kong and PwC Shanghai, not for accounting fraud, but for their failure to prevent employees from fraud
insider
in
trading.
terms of training.
Yeah.
So there's no concern on Chinese firms per se.
That's remarkable. Wendy, do you see market concerns about this? Are investors, fearful that Donald Trump may, for example, appoint somebody who is systematically anti-China on PCAOB, and that PCAOB would restart an escalation with the CSRC, even if it's for no actual reason in terms of behavior. How is the investor community looking at that risk from your perspective?
That's a very good question. I think people are looking at the cabinet members being proposed and trying to make an educated guess as to what the future policies are going to be. And this is a period where the market tends to be a little bit more wary. So we did a study of how China equities traded broadly around U.S. elections in the past 3 elections. And perhaps this could give us a general sort of sense. So
Wendy, sorry for the interruption, but when you say China equities, that includes mainland and Hong Kong, right? Or does it also include the ones listed in the US themselves, like Alibaba?
We look at MSCI China, so it has very large representation of the internet companies. Around 55% are internet and communication services and consumer discretionary. Yeah. And a few of the healthcare companies. So that's
basically all the big platform companies, Alibaba, Tencent, Pinduoduo, JD, they're all in the index, right?
They're all in the index. They're under what you would term as consumer discretionary. So at the GIGS level, 1 level. So I think when we did that analysis, the finding was that from 1st of September, in the last 3 elections, excluding the one we have currently, from 1st of September to the election date, MSCI China outperformed EM, which it did again this time, okay? And from the election day to the end of the year, MSCI China underperformed EM, and somewhat related to the concern that you flagged, okay? Particularly in the last 2 elections. And then from the 1st of January to the subsequent spring peak, China equities outperformed. And so we're keen to find out whether it's going to be, the same case. So from this point, what we could see is that global long-only funds are not keen to return before they have a good understanding of the new administration's policy. Okay, so the biggest underweight we find, or the persistent underweight we find, are with global funds. Okay, and so this is the client base that would have the most question related to what you just raised. Okay, and at this point, I think most people's concern are surrounded by the rhetorics on tariff hikes and how much this may impact 2025's GDP growth. When would that be phased in? And if there is going to be a significant impact on the exchange rate. So the listing requirement, I haven't seen too many people talking about that at this point in time.
A question from Chandler Huang, who is asking about the CSRC A share, so that refers to the shares listed in the mainland, regulatory tightening in August 23 last year, that the CSRC indicated that it would limit the supply of new stocks, at least as Chandler describes it, in order to stabilize share prices for the stocks that are already listed. Laura, can you give us your view of that? How did that impact the pictures that you painted for us?
Absolutely. So it is right observation that although the CSRC has reformed its IPO system to the so-called registration system, but there is still review. There is still implicit approval. And as you know, Chinese authorities is always concerned about our market and concerned about our investor protection. Therefore, when the China's market is going down, for example, in recent months, they will naturally slow down the IPO approval process. So there is still regulation, there is still control. And therefore, if you look at the last a few figures I show you, in mainland China IPO market, the peak was at 2021. There are about like 500 new issuers. But then in 2022 and 2023, definitely it's inverted U shape. The number of IPO has been definitely declined. And if you talk to people practitioner in the IPO market, they will tell you, okay, effectively there is still a lot of approval and there is still control on the IPO speed in order not to flood the market. So this is absolutely true. That's why I say in principle. And furthermore, it's not only about the control of the IPO, it's also about what type of firm that will go to mainland China IPO market. And these would be the firms consistent with China's economic priority. That is put on emphasis on cutting edge technology, in particular self-reliant technology. And so there is definitely a preference in terms of industry. Okay, Nicholas, may I also come back to the previous point you asked? So,
sure.
So you were surprised that the PCAOB inspection actually ended up quite peacefully, which is
actually
true.
I was not surprised, but I know that many people were surprised.
Oh, okay. So well, it at least ended up peacefully. But I do see concerns on the other regulation, which is the executive orders.
Right.
See, now these orders are called China military firms, or have ties to China military and surveillance firm. You can easily to imagine, this negative list can extend from military to surveillance and to maybe censorship. Okay, if a firm is identified as help Chinese government in terms of censorship, then it could be extended from the executive order to include these firms. For example, Weibo is a US listed Chinese firm, and Weibo is the China version of Twitter. Okay, and if someday it is identified to help Chinese government, local and central in terms of censorship, there is potential risk to be included in the list. And similarly, you can imagine other firms, let's say, produce laser technology. This technology could be for civilian use, but it can also be used for military purpose in the battlefield. And so if the executive order extend to include these firms, then US investors will also be prohibited from investing in these firms. So from this point of view, in light of the recent, election outcome, I probably would be more concerned on, the so-called executive orders.
You showed us, Laura, what you called, taking the bull by the horns, typically smaller but dynamic Chinese firms going public in the US in pretty large number. You said highest in 5 years. Was there a previous peak before COVID, or is that actually unprecedented numbers?
I would say 47 is definitely quite a substantial number. There are waves in early years, but in the recent 5 years, this is quite a substantial.
Exactly. And so is it your impression that this flow will dry up now that we know that Trump is elected, that people were hoping these people were probably hoping for the election of Harris, or do you think those firms are so eager to access the US that they will keep taking the risk of going through all the process, which is burdensome for US IPO, despite the risk of Trump and Rubio and all the new team at some point just kicking them out? How do you see that?
Very good question. So if you look into the profile of these firms, you will find a large proportion of them, they do not make positive profit. Well, in principle, it's still possible, but then they have to demonstrate that they are really innovative firms in order to be listed in the mainland China. So in other words, they are still not eligible to list in mainland China. And these firms are also very, very small, compared with IPO in mainland China. So in other words, I would still say these firms are very unlikely to list in mainland China. But for them, if some of the entrepreneurs are really eager to cash in and to protect their fortune of wealth, then they may be willing to take the risk of probably being delisted in the future, but they still want to catch this window of going public in the US.
Why don't they just go to Hong Kong? Because Hong Kong, on the face of it, looks like it has the best of both worlds, right? You escape the capital controls, you have a different philosophy of IPO registration, you don't have the negative list, or correct me if you have it, maybe you do, but you're kind of one step removed from Donald Trump. So can you give us a little bit more of that trade-off between Wall Street and Hong Kong?
That's a very good question, and in fact, relatively easy to answer. Firms, time, and choose location of their IPO, depending on the market sentiment of different IPO location. What happened is US market has been in a bull market for several years. And we have seen these, all the major index just reached all-time high. But that's exactly opposite in Hong Kong. If you look at a Hang Seng Index or Hang Seng Tax Index, it has always been going down. So all else being equal, firms would love to raise more money in a market, in a bull market, which are more likely for investors to price them with a higher valuation. So for this purpose, I think it is the bull market sentiment in the US market and potential high valuation that are bringing these firms from the Hong Kong Stock Exchange to the US.
When Laura had a slide where said basically the crackdown ended at some point, I don't remember, was it September or October 2023? So about a year from now, a year ago, sorry. How do you see the animal spirits? I'm sure you get this question all the time. I mean, are entrepreneurs, are investors willing to give Xi Jinping the benefit of the doubt now, or after what happened in the 3 years, 2020 to 23, it will take many years, if at all, for confidence to come back? How do you see that question?
When we look at the broader momentum in the recovery, it is a little bit weaker than before. We don't have a good measure of what we're trying to measure or assess, but we could see the pace of recovery since the reopen has been slower than before. So if we use a quantitative metric, looking at the 4 quadrants of growth, contraction, recovery, expansion, slowdown, China tried to move from contraction into recovery right after the reopen. But we could see after the spring of 2023, there's a bit of a pullback because that's when people saw reinforced effort at anti-corruption. Okay. And yes. And then in 2023, it was mostly stuck in terms of growth momentum in the recovery quadrant and occasionally dipping back to contraction. And I call recovery the spring equivalent of the growth. And so 2024, in the first quarter, we actually saw a spurt into the growth zone, which would be the summer, but then it pulled back very quickly. So when we look at the sectors that have been impacted, there's been the healthcare sector in terms of procurement. And this year, I think, particularly for the financial industry, asset managers were in scope. And so that also had an impact on consumer confidence. But luckily, lately, we've seen a bit of an easing or pullback of the compensation clawbacks and etc. So we could see this dampening effect because the regulatory pendulum. But then in other places on the Asia market, you do have a bit of a conscious effort of reducing supply and giving more liquidity to institutional buyers, particularly for ETFs, for larger cap size companies.
So Tianlian Huang is asking another question, which is about the instruments that the PBOC, the People's Bank of China, has unveiled a couple of weeks ago or months, providing funding for share buybacks, for leveraged investment in stocks, things that are bordering on the unconventional, really to stimulate market prices. Do you see these measures gaining any traction, or has the market effect been basically non-existent, Wendy?
That has really helped to stabilize the Asia market, because when A shares had this, the Shanghai Composite fell below 3,000 points in August and parts of September, then the retail tend to think valuation has lost its anchor, right? So the new mechanism did help to stabilize sentiment. And if I look across the world, US included, 401k was very instrumental in helping to expand the multiples in the US. Pre-post 401k, the multiples were different. And in Asia, the BOJ helped to stabilize the Japanese market. And then when we look at India, it has the systematic investment program, and that helps to channel public savings into the equity. So China to date hasn't had a systematic program to channel savings into the equity market, and perhaps this is the early version of that. We're watching, we're tracking, and these facilities essentially allow qualified institutional buyers to focus on buying and adding positions in CSI 300, right, the large cap, A50, and then to some degree CSI 500. And so helping to provide a bit of an anchor on valuation.
So we're getting closer to the end of the hour, but I want us to spend a few more minutes on the variable interest entities. Laura, you mentioned these very bizarre pieces of legal and financial engineering in which essentially investors in what they think of as shares of Alibaba or the like actually only have rights to something that tracks the economic benefits of the company's activity, but they have no ownership right in the company itself. And to me, it's amazing that these things can still exist after 30 or more years of practice. You mentioned there are 166 VIEs currently listed in the US, and basically not a single one of them has just done what they could do, which is telling their investors, it was nice to know you and goodbye, we're taking all the money and we run. How is that even possible? How has this extraordinary level of collective discipline been, maintained, given the obvious flaws of the scheme itself?
Yeah, it is amazing. I think it started in 1998 when the internetter, Signal, invented this structure. And so far, not only this 166, if you look at the top 10 market cap listed in the US, only one firm, Beijing, didn't employ a VIE. All the remaining all employed a VIE structure. I think there had been some dispute in a few cases. Let's say 360 delisted from the US and relisted in China, which of course delisted at a low market valuation, which caused a loss of valuation of shareholders in the US. And there had been actually lawsuits, and there had been dispute. However, this dispute have never really been settled down, because there is no China's law which will apply to this VIE structure. So I think the risk is always there. Of course, with the recent regulation from the CSRC number 43 document, VIE structure is recognized finally. And of course, the firms have to make really clear about the ownership and the obligation and the contractual agreement. And I think from the US side, for China-based issuer, VIE is a risk factor highlighted by the SEC. SEC will require this issuer to really make it very clear the risk is there. But I think the risk is well realized. Remember, in my research, we find these firms, they actually had a 60% valuation discount if they were listed in mainland China. In other words, investors do see this risk and they probably have priced in this risk.
That's right. That's right. The thing that fascinates me is that we still have this negative list in China, right? I mean, if you're a company in China which is invested by some foreign capital, say, venture capitalists, you're on the negative list. Since the Chinese government seems to want to, revive the stock market, have more private sector activity and vitality, this is probably a very naive question, but why don't they get rid of the negative list entirely? Because it's so counterproductive in terms of the signal it sends.
Indeed. 2 points. On one hand, you're absolutely right. The list is getting shorter and shorter. And the most recent 2024 negative list eliminated any restriction on foreign investment in the manufacturing sector. So no problem. Foreign investment, highly welcome. However, on the other hand, if you look at the remaining 29 items in their negative list, 2024, you would understand why. For example, internet news provider is still prohibited from foreign investment. And another is gene diagnostic. So now you see it's more about her national security or more about her censorship. In other words, it is still concerned about her remain control with the Chinese government for certain sectors.
Wendy, any comments on these two issues, the VIEs and the negative list?
It's difficult for us to comment in the sense these are regulatory decisions. And then I think the entity that came to the agreement with the PCAOB was not the entity that presides over the negative list. So I think for the longest time...
talking more about the Chinese negative list, the negative list as Laura described it, which is defined by the Chinese government for no investment by foreigners.
Precisely. So the regulator that presides over the negative list in China is different from the regulator that negotiates.
Okay, I misunderstood you. Yeah.
So I think it's sort of it's a complex situation where there are different regulators involved in what we think as a straightforward issue. So hopefully there'll be greater clarity in the quarters ahead or the months ahead under the new administration. I think for the longest time, there wasn't possible to come to an agreement with regard to the PCAOB ask, precisely because it wasn't very clear which department should be making that call. And then the listed companies fall under so many different sectors. Are the sector regulators also, involved? So I think it's just a bit more complicated at this point in time for that to get decided. Appears to be
interesting, very enlightening. Thanks so much to both of you. We're at the hour. I, as usual, could continue for hours, but cannot. But we'll come back to that issue, and we hope to have you again at Financial Statements. The next session, as I said at the very beginning, will be just in 1 week's time, unusually, on Monday, the 25th of November. Before Thanksgiving, for the American participants, we'll come back to the Basel Committee, and especially its process of regulatory consistency assessment program, which was a very innovative way of assessing whether individual jurisdictions are compliant with the Basel standards or not, which was implemented under Basel Committee Chair Stefan Ingves, who is kind of a living monument of prudential supervision and regulation among us. So Stefan Ingves will be our first speaker. The second speaker will be Patrick Honohan, former World Bank senior executive, former governor of the Central Bank of Ireland, and now also with Peterson Institute. It will be a very interesting conversation. Join us in a week's time. But in the meantime, thanks many very wholeheartedly again to Wu Guiying, and Wendy Liu for a very illuminating discussion of the prospects and situation for Chinese listing. Thanks so much again.
Thank you.